What is up, YouTube? Welcome to the first episode of Due Diligence, Due Diligence. And today we're going to be doing some fundamental analysis with one of my good friends, Noah Malik. If you guys missed the first episode of our Due Diligence Dude podcast, he was our guest on that episode. So make sure you go check that out if you haven't already. But without further ado, let's get started talking on what we think is a super deep value pick. Something that my buddy's been looking at for a while. So without further ado, here's Noah Malik to tell us more.
Yeah, glad to be back on the DDD podcast here.
We're glad to have you.
Yeah, so I guess this is kind of a project I've been working on for the past little while here. And I guess what we want to look at here is BERY Global. So this is just their most recent earnings presentation. And I guess just who BERY is at a glance is they are a plastic manufacturer. And they're currently listed on the New York Stock Exchange under the ticker BERY. And their current market capitalization is, I think, around 7.7 billion, I think, as of last week. And who are they? They are a plastic manufacturer with 4 different segments, as we can see over here. So again, consumer packaging on both internationally and in North America. And then they give like a kind of a breakdown of their revenues here, as well as health and hygiene, and engineered materials with, as we can see, over 300 locations, 47,000 employees, in over 39 countries and 5 continents. So by no means are they small. And that's kind of who we're going to take a look at today, I guess.
Yeah. So I just double checked. They're actually at 7.6 billion. So even more of a deal now.
Yeah, exactly. And the stock price has taken a little bit of a tumble over the last little while, and that's kind of why we're going to take a glance as to why we think they're trading at these multiples, and why we think that maybe this is not really appropriate.
Yeah. So as you said, this is a plastics company, and probably the first thing you're thinking is why are we talking about a plastics company? Like, this is obviously not a sector that's extremely favorable for most people in the markets. Much like oil and other sectors where there's a lot of ESG concerns. For that reason, we found that their multiples have been very compressed. And along with a couple other factors, we're going to talk about why we think that there's a lot of upside potential in this name. So should we continue through this, or do you want to?
Yeah, so I can stop my screen share quickly here.
Okay, yeah. So that's just a quick overview of the company. Let me share my screen here. Cool. So
this is like kind of a report I made, and obviously it's a little lengthy, but I guess I kind of just wanted to go over the highlights of it.
Yeah. So let's start with the origin, maybe.
We could just start, I guess, with the origin / background of who they are, kind of, and what's been going on within the last year. So I guess just to start, as we said, like, BERY is a plastic manufacturer, and they've been around for quite some time, and where they actually IPO'd in 2012 by Apollo Global Management. And the business, I guess the thesis here is the business has been pretty stable over time. Not a lot of revenue volatility, strong earnings per share growth. However, the problem is, if you want to scroll down to some of the appendices,
sure.
You go all the way down to some of the appendices. You want to look at the 5-year price returns.
Just tell me when to keep going.
Yeah, keep going way down.
All the way at the bottom. Here we go.
Yeah, keep going. Keep going a little bit more. I think one more. One more after that. Keep going.
What are you looking for?
Sorry, there we are, right here.
Okay, here we go.
Top right here. So yeah, so if we look at the price returns over the last, 5 years, you can see that there's kind of like, so the company has returned 19% over the last 5 years, which obviously is, all right. But then you look at some of the relevant indices, like the Dow Jones and the S&P, they're returning, 67% and and 90%. And then we look at some of their 8 comps, and their average is well above BERY's 19% at 59. So that kind of begs the question as to, what's kind of the problem with this company. They've shown, some good revenue growth, good free cash flow generation, and we're kind of trying to figure out why, the returns have kind of been pretty stagnant over this 5-year period. So if you go up a little bit,
Sure.
keep going. Well, to the top of the appendices. That one.
This one?
So that top exhibit there, yeah, kind of shows like what they've been doing with their free cash flows as of late. So again, in their most recent quarter, they've kind of projected 1.7 to 1.8 billion dollars of free cash flows, and they kind of showed here in this kind of wheel how they kind of want to allocate these free cash flows. So they kind of showed 800 million of that is going to capex, and they kind of split that up between growth capex, so the kind of ways they want to kind of grow the business, and then there's maintenance capex, which just kind of your up and keep of the company. And then we kind of shift the focus to portfolio management, which has been a big focus of the company actually. Specifically, I guess their mergers and acquisitions, where they've actually completed 47 acquisitions to date. So by no means is that a little bit, and I guess that begs kind of the first problem was this company has a lot of debt, and then you can see that, I guess, in the capital structure, where I guess the company is 55% of their capital structure is debt, whereas their competitors, the average is about 30.
Yeah. Do we have that? Do we have that comp picture?
Yeah, if you
Is
scroll
that in
down
here?
a little bit,
I think we have that comp.
yeah, it's right there. Oh, right there, the top one.
This one?
Yeah, so you can kind of see like the different capital structures
Yeah. So
of
this is,
some. Yeah.
yeah. What, maybe we can talk about this for a little bit. What do you think about their debt structure? Because when I look at this, obviously, I wonder, why is their debt so much higher than their peers? I know that you were saying that a lot of the activist investors that have been a part of this company have been looking for deleveraging, and they actually have been deleveraging. So what would your comments be?
Yeah, so obviously, if we look at this capital structure table that we have posted over here, we can kind of see that their capital structure is clearly an anomaly, like compared to the others, where like I think it's like 54, 55% of their capital structure is debt, whereas their competitors, it's not even close to that. And I guess what we can say, a lot of that is attributable to one specific acquisition they made in 2019. And it was to the tune of, I think, $6.5 billion, and 6 of that was financed through debt. So overnight, their leverage almost doubled. So yes, they had a lot of positives out of that acquisition, but based on the appearance of their balance sheet, people didn't love the amount of leverage that they had, and it's kind of like they're operating as a private equity firm almost with this much. Like, it's kind of weird to see a company like this have that much debt, to be honest.
Yeah, especially when you have, shareholders that are looking for deleveraging, and especially in an industry like this, where one of our recommendations might be to deleverage the company in order to take advantage of the assets, and
Exactly.
you don't want to have so much debt in an industry where there's not as much growth. Like, as you can see, and there's not as much
Exactly.
fracking, for example. It's not something people want to see more investment in, but not necessarily that there won't be returns, because as we've shown, there's, they've increased their EPS, they've increased their free cash flows, and the actual business metrics seem to be improving.
Yeah, and the company is actually, as of the last 2 years, they've had a couple shareholder activists reach out. One of them was in late 2020, I think it was, and they said, "Hey, we kind of are not comfortable with this situation with this much debt. We like the business, but we kind of want to delever." So if you scroll down a little bit, I think it's one exhibit, or two. Yeah, the bottom one there.
The
Yeah,
leverage.
that bottom one. It kind of shows. So since that has happened, you can clearly see that. So the company has taken down the amount of debt they have. So I guess leverage in this case is kind of net debt, which is like the total debt they amount to have less the cash on hand, divided by their EBITDA, like earnings before interest, depreciation, and amortization. So you can see that that's clearly been the company has taken an interest in doing actually delevering,
Yeah.
which is a step in the right direction, you would think. However, we kind of see this is where we kind of don't really understand where the market is headed, because here this is what we thought was the problem. The markets didn't like how much debt the company has,
Yeah.
And that's maybe therefore why it's trading at a lower multiple than their comps. So I guess if you want to pull up,
Yeah, I think that's just right about. Oh no, this is the free cash flow.
one up from that, yeah. If you wanted to touch on that, if you wanted.
Yeah, so if you take a look, this is one of the things, or probably the most thing that is drawing us into this company is obviously their extremely low multiple compared to their peers. I mean, if you look at these multiples in general, they're all extremely low enterprise value to EBITDA multiples. Even if you compare it to the S&P 500, which don't quote me on this, but I want to say it's around 19 or 20 is the average multiple. So if you're getting a low multiple like this, that basically means that it's cheap. But again, it begs the question: why is BERY trading at such a lower multiple in comparison to its comps, which are other plastic companies basically doing the same thing?
Exactly, and actually, so these multiples are slightly stale. I think as of a couple of days ago, it was actually even lower than that. It was, I think, 6.9.
Yeah,
6.9. And I guess if you scroll, what even makes even less sense is if you scroll down to the free cash flow yields. I mean, that even makes even less sense to the story.
Yeah, I mean, you have a company that has extremely low multiple, and then at the same time, it has the highest free cash flow yields out of its peers. This is a great number, obviously. I mean, 12.3% free cash flow yield. It's pretty incredible.
Yeah. So that kind of leaves, that kind of leaves us begging the question, what are we missing here? Like, well, what's the story? Why is it trading so low relative to its peers?
Yeah, because at face value, you take a look at this. If you're just looking at the numbers, you had no idea what this company does. You said, well, this looks pretty cheap, like it's a profitable company, and they seem to be listening to shareholders, and reducing their debt and doing all these things that they need to do. Yet the multiple continues to compress.
Exactly.
So maybe we can get into what we think maybe some of the bear cases are, and then finish off with going over some of the options we think they have for increasing the share price.
Yeah, exactly. So I guess kind of reiterate some of the problems that they have. We kind of identified 3 different problems that this company has. And number one is their M&A track record / leverage philosophy. They've had some questionable acquisitions that used a lot of leverage. Some of them didn't really work out. Some of them did. And it's kind of led the market to believe maybe this is not the way they want the company to move forward, and kind of seize M&A activity in the meantime. And the second problem that we kind of thought was, the company hasn't historically been the most shareholder friendly. And by that, we mean they don't pay a dividend, whereas their 7 other competitors do. And in addition, they haven't been the most generous with share buybacks. And to where actually, I think last year they only bought about $50 million in share buybacks, considering, their free cash flows were close to almost 800 or 900 million. Right. So it's kind of insulting to the shareholders, I guess, in that sense, that, yes, they want to be a part of this whole long-term strategy with respect to the mergers and acquisitions and all that, but they do want to see some returns. So in the short term.
Yeah, I think especially with a company like this, in an industry like plastics, I think you're going to have a lot more short-term minded shareholders who are looking for quick return on capital, and especially like it's a high free cash flow business. So, I mean, you wonder why they can't pay a dividend, or they haven't.
Exactly, yeah.
Not that they can't, why they haven't paid a dividend. It's really the question you should.
And I think it has to do with their management. Again, the management has kind of been laser focused on this whole M&A strategy. They want to, be totally vertically integrated, and this is more of a long-term play, and which is totally fine. But some of the shareholders kind of, and as they should, want a return on their capital, which is totally fair. Which kind of begs the question of whether this business is actually fit to even be a public entity versus operating back under the private equity umbrella, which they kind of did prior to their IPO in 2012.
Yeah, I think maybe we can get into that in a second, but one of the suggestions that that we have and also like other shareholders have had is potentially taking this company private. I mean, we've seen, for example, oil companies that aren't able to, they're not able to trade at what would be a fair multiple on the public markets because of ESG concerns and basically just a souring of industry sentiment in general. So taking them private might allow them to operate the business as they see fit and take out as much cash as they can from the business, return it to shareholders.
Exactly, yeah. Then the only problem I guess we see with that is their market cap is 7.6 billion or something like that, with pile on top of that another 8 billion in debt. It'll be quite a hefty transaction, assuming they're taking on all the debt. And how many financial sponsors are have the capital to do a 15 to 20 billion dollar deal? It's that concern.
Yeah. So why don't we go over the three scenarios that you've pointed out?
So we've kind of identified, I guess, in short, 3 different scenarios in which we thought would bring, solve the problem of 1, deleveraging, and 2, returning capital to shareholders in a much better way than they have historically. So I guess with the first one is the privatization, which we kind of brought up previously. Again, we see so I actually built an LBO model on this, and it kind of showed that I guess this company has to, in order for privatization to occur, the company's shares would have to be bought at a premium to their current share price in order for shareholders to actually tender their shares to whoever is buying it. So you kind of have to see different premiums on share prices in range of 15 to upwards of 35% of the current share price, and it kind of showed that it's delivering returns upwards of 16%. So in that sense, it's pretty attractive to some financial sponsor, but it's a matter of who's the sponsor. Is it going to be
who has the money to put to do a leverage deal on a plastics company is the question.
Yeah, and I guess if you want to scroll down to one of the appendices, we took a look at some precedent transactions that occurred.
I think you're at
yeah, keep going.
We could show
that one. Yeah, so this kind of shows that there is a market clearly for plastic companies, and you can see that like some of these deals are taking at like the average is 10.2 times EBITDA. So I mean, BERY's trading at 6.9 times right now, and there is a market for it. It's just a matter of this is probably fall in the top, I don't know, 100 deals of all time. This were to go down, or I don't even know. It's pretty sizable, so in that sense, it's a bit constraining.
Yeah, if we look at, I mean, this deal here was. Is this in millions or billions?
Millions.
Millions. Okay, so so it would be a lot larger than these deals.
Yeah, and that's the thing. It's quite a sizable deal. So in terms of feasibility, hard to say. Yeah. Hard to say.
Although you just can't ignore the lowest multiple, and this was in like in 2016. I mean, more recently, the average has been around 10x multiple, which it's trading at about like a 6, 7, something like that. I guess it could have changed today, but it's obviously there must be a reason that it's trading so cheap.
Yeah, and there must be a reason. And again, they've delevered. Hasn't, if anything, it's actually made the multiple even lower. And that also might be because of these geopolitical concerns in the market and some industry-wide things that are happening, but still doesn't explain why it's trading so much lower than their competitors.
Yeah.
So yeah, if you want to scroll up to some of their other options.
Sure, let's take a look. We can go. Do you want to go over the LBO quickly?
Yeah, sure. It doesn't really matter. I mean, like, I guess in summary, this kind of shows.
Yeah, like some of the predictions that we have.
Yeah, so I guess some of the assumptions up on top. So up top in deal assumption, this shows in our base case 20% premium to the current share price. So it's roughly around $70-something.
Even more than 20% premium at this point. That's like it's like 30% almost.
Yeah, and then it shows they take on the total amount of debt for total EV of what is that, 18 or 19 up there?
Yeah,
can't see really, it's on small.
19.
Yeah, and so sources. So the paragraph kind of under that is how the financial sponsor would kind of fund it. And what I kind of assumed was right now the company has, I think, 3.8 leverage, which people still don't really like. But this goes under the private equity umbrella. Obviously, they're more comfortable levering up. So in that scenario, we kind of assumed 6 times multiple on that, which kind of showed that I think it's about 70% of the purchase price is funded by debt, and then the rest capital from the financial sponsor. And then basically
for a deal this large, you'd probably need that much debt.
Yeah. So again, so we kind of assumed 70% of the deal would be funded by debt, which in a normal PE deal, it's pretty standard. Could be anywhere in range of 60 to even 80 in some deals, but yeah. And then so what's kind of going on below is kind of a projection of their free cash flows over the next 5 years. And then basically that's you basically want to find the IRR. So you have your initial purchase price, which is what they put in, the equity value from the sources. Then you kind of collect your free cash flows over those 5 years. And then you have your sale, which is kind of assumed to be in 2027, when the company finally kind of figures out this whole ESG concern and things like that. And maybe that's in that time, it's kind of sold to another private equity firm, or maybe it's taken public again, who knows? But hopefully at a higher multiple, assumed 10x, which is kind of in line with some of their competitors and some of these precedent deals that have taken place.
Yeah. Okay, let's go on to the second.
Yeah, so yeah, the second point, or maybe even,
or we can,
I think maybe the third point, honestly.
Okay.
Yeah, that one.
Yeah. Well, maybe what was it? What was their second one? Accelerated deal. Yeah, we kind of already spoke about that.
Yeah.
Yeah. But again, all these things could happen in confluence too. It's not necessarily that one of these. I guess the leverage buyout would happen on its own, but they could deleverage and also do buybacks and dividends.
Yeah, exactly. And I was curious what your thoughts are. If what you think, how you think the multiple would change. Let's say if the company implemented a dividend, and kind of they've already have committed to doing 350 million now in the next fiscal year in share repurchases. So they have a $1 billion authorization, but have only committed to 350 million in this fiscal year, and kind of projected to exhaust that total authorization by 2023. So the argument is, you think that's enough to bring up the multiple?
So I would think, I mean, looking at that free cash flow number, like comparison to their peers, it's shocking that there is no dividend.
Agreed.
Especially,
I would agree, and
it's
that
very
that
shocking,
can't do any harm implementing a dividend
right?
for sure.
I'm personally less. I would rather a dividend than a share buyback. I feel like a dividend does more. I mean, I guess it's similar, but I think a dividend, you're directly giving it back to shareholders. But it's like, I've never been a fan of a company buying back their own shares. It signals that, like, what else are they going to do with the money? You'd rather
Well,
just give
so I
it.
guess with respect to share buybacks, it kind of signals a couple of things. One of which is it kind of leads to believe that management thinks that the company is trading cheap.
Yeah, you also
Which
definitely could think
and
that.
obviously they clearly are trading cheap. So that's what kind of signals. But more importantly to that, it kind of shows that the company and management believes in the long-term viability of this business. Because if you see, some of these insiders selling off a bunch of their shares, not trading really cheap, not doing a ton of buybacks, maybe they don't see the viability in this business. But it is definitely a step in the right direction, share buybacks. And dividends are also, because I guess with respect to share buybacks, it is capped, right? So they have an authorization and they can't go over that limit as to how much they can repurchase. Dividends, you can do whatever, right? You can do whatever you want.
Yeah, I think a strategy involving both of them, it's definitely never like, you can never really fault the company for buying back their own shares. It's just personally, I would question why are they not reinvesting it back into the business? I guess I would rather see a dividend than a higher dividend than more share buybacks. But I think, as you've seen, they've authorized $1 billion for repurchase, and they're only doing 350 million. I think you could even raise that.
That's the argument.
What are they doing with their?
And I think management really is laser focused on this M&A strategy and trying to cut down their costs, try to be as vertically integrated as possible, which is fine. But at the same time, you do want to please shareholders, specifically large shareholders, and get their return on capital that they want.
Yeah, I think maybe we should just like come with a little bit of a conclusion. I feel like we've kind of gone off on like all these bearish stuff, because you can't ignore. I mean, there's a reason that the multiple has depressed so much. One of which obviously was in the past management's. I was gonna say ineptitude, but that's not really the right word. They're just not necessarily aligned with the shareholders in terms of what their goals are. Which is, you never really want that in a business. You'd like the shareholders and the management to be aligned. I think now, especially with all the activists that have recently joined and become more active on like telling the management what to do, I think that we're going to see more aggressive deleveraging. They've clearly shown in the last year they've delevered like from almost 5 to 3.8x. And I suspect that they're going to continue doing that. And then if they add in they could easily add in a dividend, and I don't see how that doesn't boost the share price.
Yeah, and especially given their projected free cash flows to the tune of 1.8, 1.9, 1.7 to 1.8 this coming year. So, I mean, in no means that's small, let alone your 800 million of capex. You still got another billion to play with, right? So there's really no excuse on that regard to please the shareholders.
Yeah.
So I guess in summary here, we kind of have different cases and different price targets, and I guess it's kind of just revolved on where the multiple is headed in the short, I guess, to medium term. We certainly don't believe the 6.9x right now that they're trading at is appropriate. And we think something or along the lines between 7.5 to 8.5 would be
that's even low.
And that's even low balling compared to competitors. But even then, it's we don't see obviously there's a lot of concerns with the business, inflation, ESG, but those are, we believe, industry-wide things, and we don't see any reason to believe it should be trading,
So different to its peers.
so much different than its peers.
Yeah,
Correct.
especially when, I mean, there's nothing for you to believe that the underlying business has not been, successful.
Exactly.
And they're trading, the internal business metrics are better than their peers, the free cash flows, and
Yeah, and diluted EPS has grown 136% since they got a new CEO in 2017. So, he's done a good job. And I think the problem is just aligning management with the interests of the shareholders, and finding, a healthy medium is going to be important going forward.
Yeah. So kind of in summary, the three options that you created, one being the leverage buyout, or deleveraging the company, and then option three is doing the share buybacks and increasing the dividend. All three of these cases, they consider all of the bearish things we've mentioned, including ESG, the depressed multiple. We're not, ignoring all of the reasons that the company's gone down, but still, nonetheless, it's trading at this insane 6 point. It's really, I think it's 6.7 today.
It could be.
Enterprise value
Yeah.
over EBITDA multiple, and at that price, compared to its peers, we think that it makes for a very attractive long at these prices. I think let's take a look. I think it's trading at down 1% today. 56.46 it's trading at.
Yeah. So
And I believe the average analyst, do you have that on here?
no, but I think the average analyst price target
It was 70.
was in range of $78. So that is a little bit stale, because that was from their most recent earnings release, which was in February. But nonetheless, analysts are pretty bullish on it.
So let me just leave you guys with one quick last look at the comparables. So obviously, BERY Global Group has underperformed its peers over the last 5 years. The whole sector, really any sector that's anti-ESG, has not really done well recently. Their business metrics in a lot of these sectors, including the oil industry too, we're seeing that having a resurgence as well. Their business metrics are increasing, but obviously the multiples are going down. At some point, you have to, I think the market's going to realize, or we think the market's going to realize, that these companies are trading at way too cheap multiples, and at that point, they will return to a fair value.
Yep. So I guess that's kind of in summary what's been going on.
Yeah, just look at this free cash flow, 12.3% free cash flow, and these companies pay dividends.
Yeah. So it's a confusing story, to say the least, and one we're still kind of trying to wrap our head around as to why it's trading so low. But the business is, has strong fundamentals, strong free cash flows, a management team that kind of knows, they have a direction that they want to head in, which is good. And they have shareholders who see long-term value in this business, which is also obviously another positive. So they have a bunch of things going for, positively for this business, and, a couple other things that are not so positive. But yeah, that's kind of the story, and I don't know if you had anything else to add.
Yeah, I think that's pretty much it. So yeah, if you guys enjoyed this and you like this kind of like deep value fundamental focused content, I think we got a lot of insights from you, Noah. I don't know if, I think a lot of people, this might be new to them, seeing what kind of in-depth research goes into, analyzing a company like this, because there's really so much that goes into it. You have to figure out, you see what that the multiple is so low, but you have to start asking questions. Why is that? How can they change that? What is the rest of the industry doing, and all these things? And then from that, you can come up with, you can find interesting takeaways from it. So if you have anything else to add, then I think we're good for now. If you guys are interested in seeing our price target on this company, make sure to check out the Due Diligence Dude Instagram. We're making a post there with a little bit of a summary on what we spoke about here, and our long-term price target. But we do believe the company at this multiple is incredibly undervalued, and there's a lot of upside. Anything to add?
No.
Yeah, anyway, thanks guys for watching. Make sure to hit the subscribe button. We're going to come out with more content, not necessarily like this. We also do technical analysis content. We have a podcast as well. Make sure to follow, learn your due diligence, and good luck investing, guys.